financial crisis and the consequence of the aggressive central bank policies we've seen over the past few years is that there hasn't really been that much deleveraging across Europe.
So Daniel, following the UK voting to leave the European Union, there has been plenty of questions about what's next for the European Union. Will it remain as a whole, or is this the start of the breakdown of the European Union? So can you just give us an overview of what the status is at present and what the outlook is?
Yeah, absolutely. I mean, I think we know that for the UK, we widely expect a short-term hit to activity, and it's very likely that the UK will flirt with recession over the next 6 to 12 months. But I think in some respects, Brexit has caused greater uncertainty for the rest of the EU, because whereas for the UK, we know we're dealing with Brexit and it's one-dimensional in some respects, for the rest of the EU, there are 27 other countries and hence 27 other dimensions that the organisation has to deal with. Now, at the same time, there are a number of points of potential political event risk coming up over the next few months. So obviously there is the Italian constitutional referendum in a few months' time. In addition, there is a Hungarian referendum on immigration, which one could argue is a backdoor vote on EU membership. There is an Austrian re-election where the right-wing party is they've already taken a large share of the vote, and it's not impossible that they could take charge of the country. And then next year we have Dutch elections, French elections and German elections. So there's a lot of political event risk coming up for Europe. And whilst the probability of any one of those events taking place and having a negative impact for the EU is probably quite small, the probability of one out of that number of events moving in the wrong direction is probably a bit higher. So I think the uncertainty for the rest of Europe in some respects is much greater than it is for the UK in isolation.
So you've spoken about Italy's referendum there and Hungary's votes. So these are countries that could actually vote to maybe exit or renegotiate some deals with the European Union. But let's talk a little bit about some of the biggest economic concerns for the European Union at present. So would you say Italy's a main cause for concern at present, or are there other areas that investors should focus on?
Well, Italy actually has seen an improvement in its economy over the past year. I think for Europe as a whole, the general pattern we've seen is that there were a couple of years of negative growth through 2013-14, and those were associated in part with the sovereign debt crises we saw across the Eurozone. And then we had this quite aggressive rebounding growth, and it went from negative growth to positive growth. And then for the past year or so, GDP growth has been flatlining at around about 1.5% for the Eurozone. And I think that's probably at or close to trend. And the issue is that with GDP growth at or close to trend, the inflationary pressures are remaining quite weak, and that in turn is making it quite hard to get relative price adjustments between countries. And it's also making it hard to reduce the real burden of debt, because a consequence of the financial crisis and the consequence of the aggressive central bank policies we've seen over the past few years is that there hasn't really been that much deleveraging across Europe. So I think Europe is the growth situation looks reasonable, but it's struggling to see momentum accelerate from here. I think in that context, we need to remember that last year the Eurozone had tailwinds from a lower oil price, from a weaker euro, and also from stimulative monetary policy. And this year, those tailwinds are all fading. And so we expect growth to level off at the same sort of level this year as we've seen last year, obviously subject to cross currents from Brexit.
Now, you've mentioned some of the Eurozone inflationary pressures there. So Eurozone producer prices, they actually fell to their lowest pace in 4 years. So what does this mean for inflation? Are we expecting this to pick up at all, or is there going to be any significant movements in this area?
We don't expect inflationary pressures to build particularly strongly. And I think there's a couple of things to think about in that context. One is that, as I mentioned, growth is probably chugging along at or around trend growth. And of course, for inflation to accelerate in the classical sense, you would want to see growth significantly above trend for a prolonged period of time. And then that would tend to be associated with capacity constraints, which in turn would tend to lead to inflation pressures. And we're simply not seeing that in Europe. Yes, growth is positive. Yes, it's vastly improved from where it was a few years ago. But it's hardly rampant, and it's probably at or around trend, certainly not much above it, other than in certain countries. So that's one thing to consider. The second point to consider is that I think we will see some push through to inflation from external sources, and in particular, I mean commodity and oil prices. So the fact that oil and energy prices are a bit higher this year than last year will just mechanically and mathematically push through into the inflation data as the year progresses. So I think there is a chance that we do see a lift to the headline inflation data as we go into the end of the year, but that will prove temporary unless we see an increase in domestic price pressures, which at the moment are quite lacking, or B, we see further continued increases in commodity and other import prices as the year progresses.
Fantastic. Well, thank you so much for joining me on the line to provide your insights. It was a pleasure.
That's a pleasure. Thanks very much for having me.
That's all for myself and Daniel, but if you did like this interview, do like and comment on Dukascopy.tv.